to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Man, it seems like the weeks just get longer and longer. Maybe it's just me, but I guess that's a good thing because I hear a lot of people, especially my age now, talking about how quickly time goes by, and I'm like, wow, that's interesting. Seems to have slowed down a little bit anyway over the last couple of years, and not sure exactly why that's happening, but hey, I'll take it. Anyway, we're going to talk a little bit about basically indexing. You hear like the index funds are the way to go, and I agree. For a large portion of the population, I use it extensively in my own investments and for those of my clients, and I think it's a great idea. So you're getting closer to retirement age. You typically want to take down some of the risk somewhat that you're taking in the portfolios. And I know nobody wants to give up the return. And I was researching some stuff. It was a money manager that I'd been familiar with a long time ago. And somebody sent me some material on it, and I'm looking at it, and I'm just like, wow. There's I don't know. They always want to put their best foot forward. But when you omit stuff, and in other words, you're not telling the whole story, that just kills me. The business is hard enough. You don't need to be out there stretching tails. And this is, it's a high level guy manages billions of dollars, putting this paperwork out there, and doesn't tell anybody that he had an old firm that he shut down and opened a new one and transferred funds over so he could start his track record over again. That's just not cool. And anyway, it bothers me because, and I get it. Almost every active portfolio manager will go through a period where they underperform for an extremely long time period. Underperform the major indexes. So if you're a technology fund, you're probably going to be compared to the NASDAQ. NASDAQ has a tendency to beat about 9 out of 10 funds in that space. If you're a large company fund, you're going to be compared to the S&P 500. The S&P 500 has a tendency to beat about 9 out of 10 funds in that space, particularly with the low level of expense ratios on the ones that I'm using. And the other thing is that they're extremely tax efficient. So if you've got a taxable account, the vast majority of those gains are not going to be taxed until you decide to sell shares in the fund. So you have a lot more control over that. And for the vast majority of people, with just a little bit of planning, you can make sure that those distributions that you might be taking, if you need to start supplementing your retirement income, you can make sure that those are going to be taxed at long-term capital gains rates in a large number of the cases or circumstances. And everybody's a little bit different, and that's one of the reasons that we're not a one-size-fits-all shop. In fact, I don't have two portfolios that are identical because people have different objectives with what they're trying to do. And what's really funny is that between a man and a wife, they come in and don't really talk a whole lot about finances. Those are interesting conversations. I didn't realize I was going to have to be a psychologist when I started working in this industry. And it's fine, I like it, uh, but it is different. People have different views, different opinions. You know, it was when I was growing up. Uh, a lot of adults would always say, "Hey, listen, if you want to get along with people, don't ever mention politics or religion." And I'm going to add one to that. Don't ever add money or investing because people have their own opinion and everybody's got their own risk tolerance. And that, by the way, is going to be the thing that guides your or should be guiding what you're investing in is how much tolerance for risk you have. And when you focus just on the returns, but you're not looking at how much risk you're taking, that's great. But you know what? The higher performing funds are almost always the ones with the highest amount of fluctuation. And there's no such thing. There's never been a fund that's had a 20-year average of better than 7% a year without having one or two declines of 40% or more. There's not one. At least not in the Morningstar database that they charge me $20,000 a year to access. It's got every fund that's ever existed back that's in inception. So you just you got to prepare yourself, and that's one of the reasons um, that I like to work the way that I do. I like to disclose everything. There's actually nothing to hide anymore. If you're really determined, you can find out just about anything you need to know financially. It might take you a while, and actually it will take you a while, especially if you're new, and especially if you don't do it every day. There's an awful lot of work that goes into just looking up one particular track record. And incidentally, try to look up the stocks that make up those funds. That takes a while. I have to get on Edgar Online. I haven't done this for a long time, but Edgar Online is a website that's put out by the SEC, and any mutual fund or managed fund that's available to the public has to file what their holdings are, and they have to file all of them, by the way. So you can find that out if you want to take that kind of time. It is time consuming. Yeah. So anyway, one of the things I kind of like about today is that if you really want to take the kind of time it takes to do this stuff, you can do. Anybody can do it. It's just you really have that kind of time. And I remember laughing a long time ago. I read something that Warren Buffett had written, or actually was quoted on. He had been doing an interview with, I think it was the Wall Street Journal, and they were talking about what a great track record he had and all that. And he said, well, anybody can do it. They just have to want to put in the kind of time that it would take to do all this, and then they have to have the patience. And and basically, what he described was a personality profile. You have to be extremely calm in the face of maximum stress. Because when you see, if you were invested 100% in stocks, which I don't know of too many people that are, I have a couple that are, but that's because they have so much money that even if they got cut in half, it doesn't matter. They're not going to be able to spend it, not with their lifestyle. and that's fine. That all by all means, go ahead and do that. You'll make more money that way, hopefully. You may not make much money for a 4 or 5 year time period. It could be as long as 10 years. And the vast majority of funds that had outperformed the stock market, the S&P 500, over its entire lifetime, had 4 to 5 year periods where they didn't just underperform by a little, it was a lot. So if you didn't know exactly what those guys were doing and why they were doing it, the goal is to maximize the returns on your investments. And a lot of them like to try to add to that to minimize taxes as well. And if you didn't know that you would underperform for fairly long time periods because the best it's ever been has not been able to do that. So the chances of you being able to do that, I don't know how many people are on the planet, like 6, 7 billion, somewhere in that neighborhood. So your chances are 1 in 6 or 7 billion because nobody else has been able to do it yet. And there's some time periods And there's some really sophisticated stuff that you're doing options on futures contracts and then all that kind of stuff. Believe me, that is that is not a cakewalk. And the people that are doing that kind of stuff, the people that are running the computers that basically that took the job of the old market makers, yeah, those guys, that's not skill. Being able to take an order at one price and execute it at a higher price and then give it to the client and keep the difference there, which is basically what market makers do. Or if they're going to sell it, they'll go out and sell it. They sell it at the higher price, take take a lower price on it more often than not. And that's what they fill the order at it, and they get to keep that profit. So you got to have big bucks to be able to do that. And by the way, now it comes down to fractions of a penny. That's how much they're making. Still not a bad business when you're doing a couple billion shares a day, right? So all that stuff it's fine and dandy. It's all going on behind the scenes. It goes on more today than it has ever in my career because you've got these things called exchange traded funds, which I like a lot. The expenses are really low. There are tax advantages to using them. If you can think of an idea of what you would like to do, there's probably multiple funds out there that are trying to do the same thing, so you don't have to do it yourself anymore. That's pretty nice. But this is the stock market. I'm just looking at the mid cap index, which has been one of the. If you go back for 10, 15, 20, 30 years, the mid cap index itself has beaten the S&P 500 by a fairly wide margin. And why? Because the better times to buy Microsoft and Google and Intel was when they were the medium-sized companies growing really fast, going on to larger companies at some point in time. That makes sense? The smaller you are, and wow, if you'd have been able to really forecast the future with a high degree of accuracy, which, by the way, I have a crystal ball in my office. You're welcome to try to use it. It's never worked for me. It's there kind of as a joke, yeah. It is also kind of funny because I used to set it like right in the front of my desk. And it was making people nervous when they came in for an appointment. So I moved it back in the corner. That was hilarious. I think it was anyway. But looked in the thing a million times, and what all I see is, glass. That's it. So not very helpful. But what is helpful is you can kind of look at the past. You can see what has worked well in the past. I wouldn't stop there. And that's the problem with the vast majority of investors. They look at the past and that's it. All right, well, you're going to look at the past. You want to know why something moved the way it did. Now you're going to have to dig. And you're going to have to dig deep. And there's a lot of effort involved. But I'm going to sum this up for you. In the long run, stock prices have a tendency to keep up with the growth in sales that the company experiences. Okay? So now all you have to do is predict the future with a high degree of accuracy on how much in sales the company is going to do. I know, really difficult. So your better bet, as far as I'm concerned, is to look at the funds that are looking at those types of things, that are using those. They call them factors. Okay, so let's get one that's got a factor of the sales are in the top, growing in the top 10%, or growing 10% or more. There's a bunch of them out there like that. So, but you want to make sure that the sales are growing. I think you don't have to use that, by the way. You can just do size. Okay, we want the biggest companies, or we want the companies that are falling in the middle section of the stock market, and forget the sales. We just want those whose share prices have moved up or are going up in the top some percentage. It depends on the fund itself of its category, and that's a really good. That's actually the S&P 500. I just described it, and the Nasdaq 100. The Dow is the only funky index out there that's way too complicated for me to explain on the radio. But anyway, the bottom line is those funds are run the way they're run, and it's all math. And the math makes sense It makes sense that a companies whose sales are rising in the top 10% of all stocks should probably be up in the top 10% or so of the companies that are in that index that are investable. It just makes common sense, but not until somebody tells you that. Because what most people look at is their research begins and ends with performance, not why they perform. And if you don't know why, that is a rough way to invest. That is incredibly difficult because you're just looking at what it's done in the past and hoping that that's going to happen again in the future. And if you don't look at each year, if you don't know why that performance has been so good, you won't be able to tell the difference between a portfolio manager who just got lucky and someone who's working within a framework, a decision-making process that has something more than emotion. And emotions, by the way, are stoked heavily by share prices that go up a lot in a short time period. That gets people extremely excited. So again, when you start bringing in the emotion, that's what starts making it really hard. And I got a few seconds before I got to take a commercial break here. So when we come back, this is one of the reasons that I like to talk about these fixed index annuities. They offer returns that are really high, very difficult to manage on your own, especially in the stock market. So I'm going to take a real quick commercial break. This is Bill Bullington. I'm here. Be back after these messages.
Face. I got that feeling that the world can't erase. There ain't a single day I let go to waste. I got that good news smile on my face. I got that beat, beat, beat.
Join the Cleveland Orchestra for an evening of Beethoven and Haydn. The sounds of the countryside come to life in Mandel Concert Hall with Beethoven's Pastoral Symphony. Beethoven's Pastoral, February 22nd through 25th at Severance. Tickets at clevelandorchestra.com.
Is it finally time to update your bathroom? Bath Planet, a division of Joyce Factory Direct, specializes in replacing and converting old showers and tubs into new, beautiful bathrooms in as little as one day. We have transformed thousands of bathrooms just like yours into a spa-like oasis that has homeowners excited to use their new bathtub or shower. Right now, all bath installations are 50% off. So call to schedule a free consultation with on-the-spot pricing. 440-243-5700 or visit joycefactorydirect.com.
Do you ever find yourself saying, I need a vacation? Vacation Fixation can help. At Vacation Fixation, we specialize in all-inclusive trips and cruises to Mexico, the Caribbean, and Disney vacations. Why choose us? Our clients book through Vacation Fixation because they are frustrated with online trip brokers and timeshare scams. Whether it's a weekend getaway, a family trip, spring break, or honeymoon, Vacation Fixation will personalize a trip just for you. Want to know the hottest destinations in Cancun, Punta Cana, Jamaica, or Puerto Vallarta? Interested in room upgrades, beach reviews, or details about resort restaurants? How about finding a trip with a direct flight? At Vacation Fixation, we take all of your specific travel requests and shop our suppliers to find the best deal. What's the cost? Our suppliers pay us so you don't have to. Call 330-573-8147 for more details. Or you can visit our website at vacationfixation.com or check out the deal of the day on Facebook. Vacation Fixation.
Everyone wants to know what's going to change. What can we expect in the future?
Heck, I want to know too.
But in plumbing, the important stuff is what's not going to change. People are always going to want their call answered by a real human who can help them.
And they're always going to want an honest, do-it-right plumber to fix the problem Wallacadoodle style.
And they're always going to want that to happen today, not tomorrow. So at Wyatt Works, that's what we focus on. That's why we're introducing same-day water heater replacement. Because let's face it, no one wants to take a cold shower the morning after they discover a broken water heater.
Well, maybe some health nut who likes cold plunging. But most of us want that hot water.
So when you call Wyatt Works for a broken water heater, we'll get your replacement installed and installed right that same day.
We'll even Wallacadoodle it by taking away your old one and clean it up like we've never been there.
Just call Wyatt Works and
Consider it done.
You've heard the saying, all good things come to an end. Well, not always. Sometimes they just take a break. That's what's happening with Our Lady of the Wayside's car donation program after 24 years and 96,000 rides donated. Pretty amazing. Here's the story. The car lot's owners sold the property, making it impossible for car donations to be accepted at this time. According to the Wayside CEO, Terry Davis, the next right steps will be determined and communicated soon, so stay tuned. In the meantime, Terry and the entire team at the Wayside thank you for your continued support of the 450 individuals with developmental disabilities in the Wayside's care. And please take note, you can still support them by making a donation at thewayside.org.
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to reach out, or if you'd like me to reach out, just go to my website. There is a form there you can fill out. Incidentally, I have to apologize because, over the pandemic, a lot of the technology companies out there, some of the really big ones, have had an incredibly difficult time keeping everything up and running all the time. So a lot of the emails that I'm getting, I've noticed the dates when they were originally sent, and sometimes it's 2 or 3 weeks away before it showed up actually on our email servers. And we use the biggest in our industry and the most expensive, by the way. So we were expecting, something a little better than that, but wow, I mean, it's just, I can't imagine the difficulty that this has caused a lot of small businesses over the last 2 or 3 years. And I feel their pain because we're going through it all the time. These vendors that provide services to businesses online have had a really tough time. And I'm not even sure what it is. I hate to even speculate about it, but just if it's been taking a little bit longer to get things done, it's not just you. It's everybody. So anyway, having said that, and this is one of the reasons when you get closer to retirement, you'd like to have a pretty good idea of what you may be able to expect. Now, you're going to have to estimate some of it. I guess you wouldn't have to. You could just take like when you take a fixed annuity, the reason it's called fixed is because you take it, you sign up for the rate that you're going to get, and then it stays there fixed. Now, some of them will only guarantee that fixed rate. It's a fixed 1 year or a fixed 3 year or a 5 year or a 10 year. Those are the most common, 1, 3, 5, and 10. Some people are coming up with 7 now, just to give you another option to have to ponder. But you could lock that rate in, or you could go lifetime. So if you're going to do this, this is going to be for your lifetime. And the one I'm going to talk about right now is a lifetime income. Typically, the lifetime incomes are some of the highest returns that they offer. Not always, but most cases, it's going to be lifetime income is going to be higher than what you get for a shorter term. So I'm just looking at the one. This is my favorite. This one I have invested for a big portion of my fixed income, and not all of it. I still have a fund I really like that's held up really well. Knock on wood. But I don't think I really have to knock on wood for this because there are a couple of them that I used. One of them just super short-term treasuries. That's doing very well. The other is an actively managed exchange-traded fund in the fixed income space. Now, when I first started using this one, that was very rare. In fact, there still aren't very many of those. And Fidelity is one of the biggest fixed income managers on the planet. They're the ones that manage this thing. I'm really happy with it. I'm not allowed to talk about the symbol or the performance on my radio show. Compliance does not like that kind of stuff. So I can tell you, if you want to know about it, I can send you some information on it. We can have a little 5-minute phone call. But I really like it a lot. Its yield is over 5% right now. That's the current yield. The SEC yield's probably 5.4. If you don't know what that is, don't worry about it. I can explain it to you on the phone or shoot you an email. But that's a really good rate. Okay, so, but here's the thing: those rates are relatively short term, and this is the message that I wanted to get out today. And you'll hear it again in the next few weeks, because this is not going to go away anytime real soon. But they're already talking about lowering rates again, and I'm just going, oh man, that is a bummer, because I know an awful lot of people who locked in a 1 or 2 year CD, and that CD is not going to come due until if they start lowering rates when they say they're going to. They're going to get that CD come due, and the rate's going to be a lot lower. So, and by the way, that's one that the rates on it will actually drop too. They'll just kind of go down when the market goes down, go up when the market goes up. It's a short term, and they're always rebalancing and readjusting. And they have the ability to increase or decrease the amount of risk they're taking. They don't invest in anything that's under investment grade, by the way. But those things still move quite a bit, just not as much as a 30-year government bond would. So a 30-year government bond sounds really safe. You should see how the prices fluctuate on those things. Holy cow. They make the stock market look calm sometimes. So you got to be careful. This is my point. You got to be careful with fixed income bonds. And everybody has access to some super sophisticated products. They just don't know that they're super sophisticated. They typically just look at, well, how much does it pay? Well, if that's all you needed to know, and by the way, you're going to find out over the next 3 or 4 years, they're going to be, wailing and gnashing of teeth, I promise you, over the fixed income market. That's one of the reasons that I like this one. I'm just looking at this, and I'm like, okay, when I'm 67, that's 7 years from now. For every $100,000 I have invested, they're going to guarantee a lifetime income. That's when full Social Security kicks in, and I don't get penalized for anything I wouldn't get penalized. You don't get penalized for the unearned income, but if you're still working at 67, or at 62, you decide to take Social Security early, you're going to get penalized and have to give a lot of it back. So there's some things that you can do around that. I'll have to do that on another show. But there's not a lot. You can't really make a whole lot of money until you are full retirement age, which is now 67. Remember when it used to be 65? That crept up a couple of years. My luck, it'll be 70 by the time I get there. But anyway, at 67, you can make as much money as you want at work. So if you have a job, keep working. I'm telling you, don't retire fully. That's what I like about my job. I don't ever have to retire, and I'll just slow down. And so don't retire. People that don't retire and do nothing, I should say. If you're going to retire, take the job that you always wanted to have. But, I always wished that I could afford to work at Lowe's. I just like the way that operation is run. My dad and my grandfather were both carpenters, so I grew up going to work with them in the summers. And I just really love that. I love tools. So that's where I would really love to be able to work. But I can't afford to go to work there because they don't pay anything. So that's my dream job, is to go in and only work 15 to 20 hours a week at Lowe's during retirement. And I will actually spend more than I earn on the tools that I end up taking home and probably having to sell on eBay because of the lack of use in them. But anyway, long story short, actually not long story short, getting back to what I was talking about. So if I put $100,000 in today, and I'm 60 years old, and at 67, I want to take an income from it. The guaranteed income is $11,407. Okay, that's a lot. To guarantee that at $100,000 put in today, that they're going to guarantee $11,407 that's a lot. I mean, that's to be able to guarantee that that's going to be there for the rest of my life. And if I die and there's still money left, they're going to refund the balance to my beneficiary. That's a pretty good deal. That's a really good deal. Now, having said that, it's different. If I wait another year, it goes to $12,512. If I wait another year, it goes to $13,669. And if I wait all the way until I'm 70, it goes to $14,931. So that's a big deal. Now, again, if you want to see this, if you want to put your own numbers in there, put your own age, and see how much money you might be able to generate, just hit me up with a phone call or hit me up with a phone call in the office, or you can send an email, Bill at Bullington Capital. But see, this is a very good deal for today's environment. Now, it'll change. Now, when I bought my first one, it was the rates were lower. But you know what? I'm still not upset because it's still higher than what I could get in bonds or CDs, and now the interest rates in bonds and CDs are going down. But my rate's not going to go down. The reason that they have the term fixed in the annuity is because it's fixed. The only way the insurance company can get out from underpaying me what they agreed to is if I let them off the hook. Okay? And I'm pretty sure they're not going to ask me to do that because Nationwide, it's been around for a very long time. They have extremely strong ratings. I've been doing business with this company for over 30 years, and they're well over 100 years old. And they've got a bunch of different divisions. That's the other thing. When I compare them to the other insurance companies that are out there, there's some that are pretty close as far as what they might guarantee down the road. But the other companies, I'm just not as I just don't have as much confidence in. Well, the last time the market really had a rough time, 2008, one of those huge companies had to go belly up. And when insurance companies go belly up, it's typically other insurance companies come in and buy their business and keep running it. The investors had to take a hit on that. They didn't lose all their money, thank goodness, but they had to take a hit and didn't get as much as they thought they were going to. And then they were offered rates that were lower than the rates that caused the company all the problems to begin with. So I'd like to avoid that if possible. Everything that I'm looking at as far as economically, there's always risk. I don't care what you're doing. There's risk of getting out of the bed in the morning. So some companies are taking more risk than others. You're hoping that the rating agencies that are going out there and looking at the portfolios are doing a good job so that you can go with those that have the lower risks of having problems. And that's one of the reasons that treasuries are so valued by so many people is that those are backed by the federal government, who owns their own printing presses and can literally just print the money and hand it to you. Hopefully it never gets to that, because inflation would be, who knows what it would be over 100% a year if they started doing something like that. And I don't think that really is not going to happen. I could see inflation rates staying. Supposedly they're starting to come back down now. And if they do start to come back down, the rates, these fixed rates being as high as they are, they just raise them. They may end up going down a little bit more closer to the ones that where I'd purchased mine. I'm not upset, by the way, that rates are higher, that somebody could come in, get a higher rate than I got when I bought mine. It doesn't make me upset at all. I still can't get a CD that's going to match mine. And, that's just how it works. If you could estimate with an extremely high amount of accuracy, then guess what? You'd have Warren Buffett knocking on your door asking, you could come in and sit down and talk with you for a while. Yeah, but that's incredibly difficult to do. It's so difficult that Warren Buffett doesn't try. It tries to identify things that are happening within a company that he thinks is sustainable, and at some point in the future, he never puts dates on anything, but at some point in the future, he should be happy that he made the investment. Why? Because it's gone up. It's increased in value, and he's a value investor. And there are tons of other types of investors out there. The two main categories are value and growth, and they're kind of attached at the hip, if you ask me. But right now, I think valuations are pretty good. I don't think they're extremely overvalued. I think the larger you go, the more overvalued they start to become. And I was hearing an echo of myself for a second there. I've got about 25 seconds here before I got to take a real quick commercial break. So I'll just identify myself again. I'm Bill Bullington. I'm here every Saturday morning from 11 to noon. If you have any questions, just go to my website, bullingtoncapital.com. If you'd like to see an illustration or set up a phone meeting to talk about the fixed index annuity products, feel free to call me and leave a message, and I will get back to you as quickly as I possibly can. And now we got to take a real quick commercial break.
I've been wandering through the desert, ain't seen a cloud in forever over me, but I believe your rain is coming. Yeah,
Thinking about updating your home? Well, Joyce Factory Direct specializes in replacing old, outdated windows. Proudly made right here in Cleveland, Joyce Windows features their exclusive Smart Shield high-performance glass, which means you'll be getting the most energy-efficient windows for your home directly from the factory. Customers just love how much warmer their house is and how easy their new windows operate and clean. Right now, you can save 50% on all installations. Just call to schedule a free consultation with on-the-spot pricing, 440-243-5700, or visit joycefactorydirect.com.
Hey friends, Bob France here for my good friends at G&J Waterproofing of Cleveland. You need to know those letters, G&J. That's all. If the basement is leaking, you've got problems, and I've got solutions. What did I tell you those letters were? G&J Waterproofing. That's it. Listen, only company you're going to need if you want to handle your basement problems the right way, for the right price, and to do it right now. And the thing I love most about G&J, the warranty. They've got the strongest warranty in the industry, literally twice as long as anybody else's. Now, how can you afford to give a warranty that long when you know you're not going to have to do a lot of warranty work because you do the job right the first time? That's what they do. G&J has won every service award there is. Both the Better Business Bureau and Angie's List give them A ratings. That's what comes with 15 years of experience treating people and basements the right way. Go onto the website. Log on to gjwaterproofingofcleveland.com and then call this number, 440-687-6079. Get a free in-home inspection, 440-687-6079. Call now.
No doubt about it, we're spending more time at home, which is the perfect time to make it more functional and beautiful. Hi, Ed Flash Ferentz here for Artistic Renovations, Northeast Ohio's premier and award-winning remodeler. Artistic did a fantastic job with our kitchen in 2016, and last year, they were back for the master bath. Oh, my word. Do yourself a favor and go to artisticreno.com. Believe me, you'll love their ideas and without question the finished product. For a virtual consultation, call 216-520-0838 or visit artisticreno.com.
If you've been walking the same old road for miles and miles, if you've been hearing the same old voice, tell the same old lies.
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can find out more about me and my firm by going to my website, bullingtoncapital.com. You can call us if you'd like to ask some questions. Number is 330-664-0700. That's 330-664-0700. And I'll be glad to try to answer anything that I can. There are some questions you just can't know the answers to, like, where's the stock market going to be a couple of years from now? I hope it's higher. I have a lot of money invested. And but you can't guarantee that. And that's the thing. As you get older, you typically want to get more towards guaranteed income. And as I was talking about earlier, I bought one of the annuities this last year, one of them, in one of my annuities. And at 60 years old, by the time I'm 67, that's full Social Security age, they're going to give me the equivalent of 11.4% on what I invested. That's based on what I invested, 7 years prior to that. So if I decided that, hey, I'm going to have to take it out at 65, the income is $9,684. It's less because it hasn't been in as long and it's not building up. So if I waited until I was 70, it would be $14,931. That's a lot. So for 7 years old, somebody who's been in there for 7 years, that's pretty good. That's really good. And there's a tool that they have. If you're interested to see how much you might be able to get on your investments, you can give me a call. We can set up a phone meeting. I can walk you through that process of how that works. And, we just take it from there. It's relatively simple. On the company's website, you can put in your age, either the income that you need or just how much you are going to be investing, and it'll tell you how much your investments might be able to generate. So that's a really good thing for an awful lot of people. And I'll tell you that the guaranteed rate that they have there are extremely competitive. So when I look at people that are looking at the stock market, if you're in your 40s or even your mid 50s, you should probably be more invested in stocks than bonds or fixed income like these types of products. But you start getting up into your upper 50s, you might want to start taking a look at it. Why? Because the S&P 500, which has a tendency to be in the top 10% of all mutual funds, or it has been over time, has a tendency to get over or have really rough time periods. I'm looking at the year 2000. This is actually in March of 2000, it peaked right around 1500. By the way, it's 48.90 today. That's up quite a bit, about 220%. But it went down 50% from March of 2000 to March of 2003. It finally gets just barely above the level that it had gotten in 2000. In 2007, at near the end of the year. So it's almost 2008. Then, over the next 18 months, it drops and goes down further than it did from the year 2000 to the year 2003. So literally, if you had invested in March of 2000, here you are, almost, 10 years later, you are down. 9 years later, you're down a lot. I mean, it's not a little bit. Let me see what this actually came to. I've got this up on my computer. About 56%. Now, you would have gotten your dividends over that time period. And it probably cut the decline down by about 25% or so because of the amount of the dividend that it was. But still, if you would have reinvested everything, it'd still be down a lot, much more than anybody wants to be. And that's the risk with stocks, is that you run up on a period like that where the returns it's really rough. Nobody likes to talk about it in my industry, and quite frankly, a lot of people just ignore it completely. But I don't think that's not a smart idea. You start looking at the returns. The returns are only half the picture. The other picture is how much does it fluctuate. And if it comes up, if a big drop comes during your retirement that you did not anticipate, you thought you were going to earn a much higher return because the average return has been very good, but you didn't realize that return was also accompanied by some major drops that took years to recover from, and that's a problem. And that can be a problem. That's one of the reasons I like the fixed indexed products so much, is that the returns that they generate are incredibly difficult to match, and they're going to guarantee that rate. Okay? Now, it's only as good as the insurance company. Let me make that completely clear. So if any insurance company has risk because they're insuring, people's lives, they're doing cars, homes. Each insurance company is a little bit different. Some of them just specialize in investment products, so which is still a lot of risk. I mean, think about what I just said. The S&P had a negative return after 9 years. 9 years, the return was still negative. And even if you had reinvested all the dividends, and that's before you paid any management fees if you did. Okay? So it's tough. Now, this one of the reasons I have a job. I literally thought I would be out of a job when I was new in my career because I thought, wow, you can sit down and you can study all this stuff and you can learn all this stuff yourself. And it's true, you can. And I know a lot of independent individual investors who handle all their own investments, and that's great. The vast majority of people don't have the time to do that, number one. And number two, those people that are extremely smart look at it and go, I don't want to deal with that. I'm going to find somebody that will do that for me, and and keep me informed and keep in touch and help me raise my morale through hard times. Because I promise you, nothing is a better example of life in general than the stock market. If you do all the right things, and you give it enough time, things have a tendency to work out fairly well. But it is a bear to get through some of those times. And doing the right thing oftentimes costs you money in the short run. What do I mean? Well, you're investing in stocks, right? Right. Why? Because they have long-term returns that are better. That's right. But you're going to wish you'd never heard about them when they when they drop by a mile, especially if you have all of your money in there. So you need to diversify it. Need to have. And by the way, there is the next seminar that I do. I'm going to set a date this week. I haven't done a seminar since the pandemic, as we haven't been allowed to. Okay, so the next seminar I do, I'm going to show you something that I think is really fascinating. I've been doing this for a long time, and there are certain mathematical formulas that funds use to select the stocks that are in them. Almost all of your exchange-traded funds, which have the best taxes and the lowest expenses, and when you add those two things together, it is I see all these returns that people advertise. This was the return. Well, that's the gross return. When you start to take off the taxes from what you might have to pay on especially a fund that's actively managed, you're going to be behind the eight ball. It is incredibly difficult to outperform the funds that I use. I mean, it's just incredibly difficult, especially if you're going to do it over a 5 or a 10 or a 15 or 20-year time period. The vast majority of funds that are actively managed just can't do it. And so anyway, and I would be glad to be able to find somebody that can and that has. And it's just very difficult. And the bigger you get it gets harder. So if a fund is really successful in its early years, it's going to put up some pretty big numbers. Those numbers are going to be incredibly difficult, if not impossible, to maintain because they're managing so much money now. And I know that's a show or a title for or a subject for another show. Anyway, when you look at what these guys are willing to guarantee on an income level for the average person out there, I just think it's a good option that you should consider. And I think bonds are a good option you should consider. I don't have anybody that doesn't have stocks, bonds, and cash. And for fixed income, this has become it's become pretty good. But for fixed income right now, anybody we had a guy call in, and I feel so bad because I know this guy was investing heavily in this one. Was a government bond exchange traded fund, and he talked about it, and he had caught a a move upward when interest rates were going down, and I knew it wasn't real sophisticated because he didn't know why it went up. I mean, he just knew that it had gone up. He'd heard that when interest rates drop, bond prices go up, and so he got this. And he caught it was only the last like third of the movement. This guy that I had talked to, and by the way, I talked to several people during that time period, had the same situation, and my my advice was, listen, you need to watch that carefully. First of all, I wouldn't have done it because you're going to have to know when to sell that thing. And if you don't, it could be really dangerous. Well, during that time period, they had not topped. Now, they were doing very well, had gone up, and they pulled back like in early 2020, and then went on to make another new high in near the end of 2020. And then it just started dropping. That was the peak. And now they're down now. These are government bonds. Government backed by the full faith and credit of the United States government. The credit rating is one issue. The interest rate risk is another issue, and that's one that they just don't talk about. They're still not talking about it. And I know why. It gets a little complicated. But being complicated doesn't mean you shouldn't talk about it. The interest rate risk has driven the prices down on that fund 45%. Let me say that again. Rising interest rates, and that's not the worst. It was actually down over 50. It's actually bounced up off of its bottom. But these are government bonds in a fund. That fund is down from its peak about 45%. So the interest rate that you are getting on that you're getting now, that's actually less than you could get on a one-year treasury or one-year CDs. The interest rate is lower than the interest rate people are getting on short-term bonds, and you're missing 45% of your principal. You don't want that to happen to you. So anyway, if you want to know how to avoid that, tune back in next week, and we'll talk more about that. If you'd like to set up an appointment or just have some questions, just go to my website or call me 330-664-0700. I got to run now. I hope you guys all have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.